Welcome to InsurTalk. Today's discussion is about insurable interest. What is insurable interest? How is insurable interest created or ascertained? A person has insurable interest in something when a loss or damage to that thing would cause the person to suffer a financial or other type of loss. So if you own a vehicle and the vehicle is damaged in an accident, you need to repair it. So you suffer financial loss in repairing the vehicle. Therefore, you have insurable interest in your vehicle. This is an example of an insurable interest by ownership. Similarly, if a property is mortgaged to a bank and the property is lost or damaged, then the value of the property as a collateral against which the bank has advanced the loan becomes compromised. So banks have an insurable interest in the hypothecated assets. Insurable interest can also arise by way of possession. Now, I will explain this by way of an example drawn from my own experience as an insurance broker. I had once placed an art insurance policy covering an exhibition risk. The painting which was sent for the exhibition was damaged in transit. A claim was lodged by the exhibitor under the policy. The loss was assessed at around rupees 10 lakhs. Now the question of insurable interest arose. The painting which was damaged belonged to the artist and not the exhibitor. So the exhibitor was a bailee. He was not the owner of the good. There was, however, a contractual requirement on the exhibitor to purchase insurance when the painting was in his custody. Therefore, an insurable interest apparently got created for the exhibitor. There was a prima facie insurable interest. Here, however, the insurable interest of the exhibitor comes into picture only after he has reimbursed the artist for the damage or loss to the painting. Otherwise, if the claim is paid to the exhibitor and he doesn't in turn pay to the artist, then the exhibitor would stand to benefit out of the claim. This will violate the principle of indemnity. Now, to pay the 10 lakhs of rupees in advance was creating cash flow problems for the exhibitor. So there was no privity of contract between the artist and the insurer. So the claim couldn't be paid to the artist as well directly by the insurer. So the claim couldn't be paid to the exhibitor nor to the artist. So this got into a stalemate. The claim got stuck. So negotiations were held to work out a solution to this issue. So the solution which was suggested was that the exhibitor would give an indemnity come undertaking to the insurer that he would transfer the claim proceeds to the artist within 1 week of his receiving the money from the insurer. On the basis of this undertaking, the insurer agreed to pay the claim to the exhibitor. The claim was paid to the exhibitor, who in turn paid it to the artist, and the proof of payment was submitted to the insurer for the sake of records. So the problem was resolved this way. So the moral of the story is that insurable interest can become tricky at times. It's not enough that your name is shown in the policy as a named insured. Just by attaching a care, custody and control clause or a goods held in control clause doesn't automatically create insurable interest. So careful consideration must be given to insurable interest while buying insurance. Thank you.